Okay, so chapter
22.
22, we're
You
gonna
do
go
good
ahead.
for chapter 22? Why?
I don't know. One of them homework problems I got confused. So I got stuck on if I didn't give me enough information.
Okay, so master budgets and planning. This is the budget process, and we just want to look at this and look at all the different things that collaborate together to create a master budget and allow management to be able to um, prepare for future things. So, starting with the things that it provides and it promotes. First, starting with promotes a benchmark for evaluating performance. That's very important already, right? With budgets, is that they evaluate the performance of different departments, the management over that department, enhances coordination so that activities of all units contribute to meeting the company's overall goals. So a master budget is going to incorporate so many different small subsidiary budgets to help management determine and coordinate how the activities are actually contributing to overall the revenue and cash flow and things of that nature. Promotes analysis and a focus on the future. That's what budgeting is all about, future projections anyway. But if you do a master budget with several budgets included, then you can kind of focus on what's going to happen for the next day or the next quarter or the next year for everything at one time. Communicate management plans throughout the organization. So because that master budget is going to be conducive of budgets that are going to be a part of each different department that the organization has, it's going to help management on all levels, not just upper executive management. Motivates employees through participation in the budgeting process. It's important for companies to include um, employees on the budgeting process because employees, believe it or not, have more of an insight to what
So,
actually goes
can I
on.
ask you a question? What type of employees they have to, I mean, to participate to
What
the
type of?
employees? Like, not the lower.
Yeah, it could be the
Oh
people
no,
that actually make the product every
oh
day
no,
could contribute
please.
to that.
I never seen that.
And we don't mean, when we say participation, we don't necessarily mean they're going in the rooms with the management and doing the budget.
Even though, but they don't ask them like some advice. They don't say nothing. They just keep moving. That's fine.
Well, that's for some companies, not all, but a
But I
lot of
can say I
companies.
know working at Walmart, they told us about all this, about the budget and stuff, especially when it comes to our hours and
Right.
stuff like
That's the
that.
biggest key that employees have is you think about these hourly,
And productivity.
yeah, hourly employees who are making at least 40 plus hours a week, right? But if the budget doesn't allow for that, the talk or the participation part of it will be discussing how you're going to have to be cut back on your hours and you're going to have to do the same amount of work in the small amount of hours that
Oh,
you're
okay,
working.
okay,
So it's that type of participation.
okay.
Converts long-term strategic plans into short-term financial plans. So generally, we know in the whole managerial arena, there's very little um, long-term strategic planning. It does exist, but they're more so concerned with the short term than the long term. So it's better to make something that should have seemed like it was a long-term goal into short-term goal, and they can do that if they can properly execute a master budget. So some companies have what we like to call a budget committee, which might be a different manager or several groups of managers from different departments throughout the organization. And they come together strictly on the budget. That's the main goal, that's the main purpose, and they don't do anything other than that at that very present time. So this is how it kind of goes with the committee. You got top management, which will probably be your CEOs, CFOs, those type of people. Middle management, which will be your what do they call them? Districts, regional managers, those type of people. And then of course you have supervisor, which those little supervisor trees are basically the people that are over each department. So you might have a production supervisor, um, merchandise supervisor, different supervisors for different departments. And something else I almost left out. Down here at the bottom, flow of budget data is bottom up. So in other words, when it comes to finding out who did what and why something wasn't done or why something was done, it starts here. Normally, typically, the route should be up here, but it starts here and it goes on up the chain because who better knows about what happened with production than the people who work right over those who actually put the product together. So budget timing. Everybody does an annual budget, and remember how at the very beginning of the semester we talked about how for managerial they do costs and things like that every day, right, to get them through the week. With this, they're talking about an annual budget and how often you would do a budget for a normal company that is not necessarily a manufacturer. Um, an annual budget is fine. Before manufacturer, we like to call budgets continuous or rolling budgets, meaning they're going to roll from month to month to month. It's not going to be we just do it once for the year because they can't afford that. Everything is based upon what has been produced, so they have to do it by month. Master budget components. So you got some operating budgets, you got some capital expenditure budgets, and then you got your financial budgets, which are the ones that you are somewhat already familiar with. So you got your sales budget and your purchases budget. These two are really important for operating because if you don't know how much you need to sell and you don't know how much you need to purchase and produce, then everything stops. Everything is at a halt because that's where all the cash flow comes from. And then capital expenditures budget. This deals with the big jobs that are being put into place, big investments. So every time more equipment is purchased or a building is purchased for use of production, yes, land, and you want to build on the land, all of that falls under capital expenditure budgets. And then manufacturing, selling, and general administrative budgets. The reason why we just put them in a area all by themselves is because this can be indirect to the product, right? And so some components of it could be direct and fall up under here. Some of them could not be. Consolidate. Cash budget, we need to know cash flow at all time. Income statement, we also need to know making sure that our expenses don't exceed our revenue. And then budgeted balance sheet to make sure that all of our assets that we have on hand hold good value, that our liabilities are not too extended, and that we have enough working capital.
Those pictures are different from mine. You see that?
What page are you on?
905.
Oh, but it's kind of the same though, because
Yes.
it said that the general and administrative expense could be direct.
Yeah, remember how I was saying it could be
Direct or indirect?
direct or indirect depending on the circumstance, but yeah, same situation.
Okay.
So starting with the sales budget, it's first of all it's important because we need to know how much we plan or estimate to make for the month. Remember I said we go continuous flow budget, so we can't say for the year, for the month. So we're looking at estimated unit sales and estimated unit price. So we're going to take the analysis of economic and market conditions and add that to the needs based on what the marketing department has determined is needed in order to sell. So this example, this person or this place sold 700 hockey sticks at $100 each. And in order for them to prepare the sales budget for the next 4 months, this is what they had to do. Because they actually sold 700 at $100, we're gonna just base the sales at 70,000, which was the actual, right? And how much do you see that it has increased as far as the units from September to October? By 300 to 1,000 at $100 to make 100,000 in sales. And then November, what happened? It went down by 200, and then by December it went up by 400. So before you ask the question of why does it go up, why does it go down, they base those numbers based off of what marketing gave them. So if marketing said that it seems that only around 1,000 will be purchased in the next month, then that's what they estimated for. because that's the data that they had. Now, they could be well over the mark or they could be well under the mark. That's the whole downside of budgeting because you never know if you're going to miss the mark. It's always a goal to hit it, but it's even worse if you don't hit it, if you don't get to that point and above it. So, purchases budget. The quantity that is purchased to be um, converted to a finished product is going to be affected by different inventory systems, just in time or safety stock. And I know we've mentioned safety stock, target stock, all of those things before. But just in time inventory is going to make sure that when you purchase quantity that is going to be smaller, it is going to be more frequent. Safety means that you are going to um, in the event that you fear that sales are not going to make, you're going to set a bar or set a number to make sure that if that is not even met, you're not going to order more. You're going to stop it right there. So with the merchandise purchases budget, you got budgeted ending inventory plus cost of sales for the period minus beginning ending inventory. And that's going to let you know how much inventory is available to be purchased. So they give you an example here, $60 each for hockey sticks, 90% of the next month's budgeted sales is going to be ending inventory. And on September 30th, they purchased 900, no, I'm sorry, 900 hockey sticks are on hand. So remember that little formula, ending inventory plus cost of sales minus beginning. So next month's unit sales, the only thing we saw, I believe, was the 900. Am I right?
Yeah, 900.
Okay. So if they're saying they're going to sell 800 in October, and then the problem did say that it was ending inventory was 90% of sales. Budgeted ending inventory is going to be 720 units plus what was currently sold for that month. That's going to be the amount of units needed for whatever they do. And then deducting out ending inventory, which that's where that 900 came from in the previous paragraph. The number of units that they actually still need to purchase are 820 units, and they're going to pay $60 each unit for them for a total amount of 49,200 in purchases for the month of October. Now, for November, what they've done or what they're showing you is that we said that 720 was the ending inventory amount, right? That's going to obviously turn into beginning inventory for the next month. So again, 1,400 unit sales times that 90% to get the ending inventory percentage gives us budgeted ending inventory units of 1,260 plus what was currently sold 800, total units that we need 2,060. Deduct that 720.
Where did they find 1,400 for November?
That's just what they stated in there. Remember, those were the numbers from the previous sales budget that we looked at. That's just an example that they're giving you. Um, and budgeted cost per unit, still the $60 per unit, multiplying that by the number of units that we still have to purchase of 1,340 to get the budgeted cost of purchasing. So it's not really going to make sense looking at it like this until you actually do a problem. Now, selling expense budget. Those are for the people that got to go out there and sell the product before it's even finished or once it's finished. It says hockey band pays sales commission equal to 10% of total sales, and then they pay also a monthly salary of $2,000 to the sales managers. This is the budget for that. Sales commission is 10%, right? Of budgeted sales. This is just what they budgeted for those next 3 months. They've multiplied it by 10% to know that they're going to pay out sales commissions of these amounts every single month for the next 3 months. And then they're also going to pay out a 2,000 base salary to the managers. So total selling expenses is going to be from the sales commission plus the manager's salary, which is pretty simple. General and administrative salaries budget, that's relatively simple. It's no different from calculating a selling expense budget without the commission. The only difference is because it's general and administrative expense, it can go either way. It can either be direct or it could be indirect costs. The key is whatever amount is under general and administrative expenses, you also have to account for anything that was used along with that. In this particular example, depreciation of equipment. So salaries were about 4,500 every month. The depreciation was about 1,500 per month. So they're adding both of those together for the next 3 months, and notice nothing is changing, right? And if nothing is changing, what that tells me is that this probably is more so indirect than it is direct cost. So capital expenditure budgets. You remember how I said anytime equipment is purchased, they make an investment in something new, land, building, factory, whatever, pavement, fence, all of that is considered to be a capital expenditure. And so they give you this scenario here where they say that they don't anticipate any disposal of plant assets, but they do plan on acquiring or purchasing additional equipment for $25,000 cash. And this is the only budgeted capital expenditure for the quarter, so no separate budget is shown. Instead, what do you think that amount is going? What statement? Think about what it is. They're purchasing additional equipment, right? Cash obviously, yes, is being decreased. Yeah, equipment. What statement is it on?
Oh, on the general and administrative expenses.
General and administrative. No, that's the budget. But when I say what statement is it going to be on, because they're purchasing it and it is an asset, it's going to be on the balance sheet.
Oh,
Okay.
right.
So financial budget, cash budget, expected receipts and disbursements. In other words, cash inflows and outflows.
Yeah.
Budgeted income statement, you know about that already. Budgeted balance sheet, you know about that as well. So budgeted cash receipt, this scenario, 40% of the sales are for cash, 60% are credit sales that are collected in full in the month following the sale. So what I'm looking at is partially 40% cash received and 60% is going to be on AR. Okay, that's what they're saying. And so this is how they budget for that. They said that 40%, 40% was cash sales. So how did we find out the 40%? Why is this thing moving? The sales, if they were and you can just calculate it. If the budgeted sales were 70,000, and you multiply that by the 40%,
You said 70,000.
70,000,
Yeah.
28,000.
It shouldn't be budget.
What do you see? 42. No, that's the accounts receivable portion. So even if you did 70,000 times the 60% that they told you, that equals 42,000.
Yes.
The one thing that they did after they found out what that accounts receivable was simply subtracted 42,000 from 70,000 to get the remainder going to cash.
Yeah, it should be 30. Don't be. It should be 40.
But what else is included in that?
Included in the budget sales.
In the cash sales. What else you think is going on? What do you think is going on?
Are they selling?
Are they selling stuff?
Cost of goods, no?
Let's go back again. And that's what, hi. And so that's the 60%. Let me see if I can make it move again.
It's moving. That's just
Let's try to.
the
Oh,
account.
are they receiving cash
Look what they
flow?
say, 40% of sales, right?
Mhm.
One is 40%, one is 30%.
What is the difference?
Between.
Instead of getting it on credit, they receive the cash for it.
No, because they told you how much they received in cash. This is the thing. This is why you don't see the 28,000 there. If you're thinking about receivables, more than likely you're not receiving receivables in the same month in which it occurred. You're gonna receive it after, because if you received it in the same month, it would just be cash. It wouldn't be a receivable. That would be no point. So if we just look at 70,000, we know out of that 70,000, at least 60% for receivables is going to be collected in the next following month. October, um, the 100,000 times 40% is going to be what? What? Times 40%?
It will be 40%, 40,000 dollars.
40,000. And then the following months, what they're just trying to get you to see is that receivables are being collected after the month in which it occurred.
That's why
That's what they're trying to get you to see.
we got one of the problem like that, 60,
Uh-huh.
60, 40,
Uh-huh.
40, 60, 60. Yeah.
Cash disbursements, meaning what has been purchased. They purchase everything entirely on account. Full payment is made in the month following the purchase. September 30th balance of accounts payable was 58,200. So cash disbursements for purchases. October payments, which came from September, which was the beginning balance of 58,200, and then November came around to pay for what was purchased back in October, and that was 49,200, and so forth.
This is the same thing as actual and budgeted.
Mm-hmm. So cash budget. This is no different from when we do a cash flow statement. Beginning cash balance plus everything we purchased, everything we received minus everything we purchased is going to give us our ending cash balance. And it gives you a notice there, if adequate, repay loans or buy securities. That's with extra cash flow if you can. We won't even go through that little scenario that they're giving you there. But it's really no different from a cash flow statement or the process that you go through for a cash flow statement. Budgeted income statement. Once you complete the cash statement, then you do budgeted income statement. And notice with this income statement, they're showing you where things are coming from. The order in which you have it in the book is the order in which you would always do budgets. You wouldn't go out of that sequence just simply because there are amounts that you need from the previous budgets, such as sales, the selling expense budget. You need those amounts under operating expenses. For the actual sales budget, you need to know what is the projected revenues from it and so forth, purchases budget and all of that. So that's just basically what they're telling you, is that you need that from that initial budget before you go on to the income statement. And then once you do income statement, you can do balance sheet. Certain amounts you need. You remember the capital expenditures budget? You might need that for the equipment purposes, accumulated depreciation, things of that nature.
The common stock stay stable.
Mm-hmm.
The common stock,
Common stock?
it doesn't change.
No. Not as far as the budget is concerned, no. But they're showing you where each of these amounts come from, what budget gives you those different amounts. And remember how we added depreciation to the general and administrative? salaries of 4,500, they're showing you that's what you put under accumulated depreciation because that's what we included in along with the depreciation. Accounts payable, remember how it said that we bought everything on credit? They brought that right over from that purchases or disbursements budget here. And I want to say, is this on here? May not be.
I like this one, it show you everything, where do you have to go to take this number away?
Okay.
You will send that to us?
913.
Yes, sure.
Well, it doesn't really, 913 doesn't really tell you
I mean, yeah,
where the
they'll go.
amounts come from. But I mean, I'll post that on the front page.
Thank you. I will copy.
So,
Actually, I think it does at the bottom.
Where? What page are you? 930?
okay, so exercise 22-6 says Quick Dollar Company purchases all merchandise on credit. It recently budgeted the following month-end accounts payable balances and merchandise inventory balances. It says use the available information to compute the budgeted amounts for merchandise purchases for June, July, and August, and 2 cost of goods sold for June, July, and August. So, starting with number 1 for calculating or computing the information for merchandise purchases for June, July, and August. How do we do a budget for merchandise purchases? You got 3 months. You got June, July, and August, right? And what do we start with?
The numbers that the accounts payable?
Mm-hmm. That's what we call ending accounts payable, which was how much in July? I mean June, I'm sorry.
1 minute. Oh, man.
200,000?
No,
150.
no, for, 200, yes, 200,000.
Okay, July ending accounts payable,
235,
235,000. August,
195.
195. And how much did we pay in June towards that accounts payable? You paid cash of $400.
No, and
No.
you said it what month?
June,
Cash payment,
yeah.
1,419.
What about July?
1,435,000.
August?
141, 1,495. 1,495.
Okay, so total payable during the month.
You have your calculator.
How much for June?
1,606,019.
July? August,
125 or 195? 1,690,000.
and what was the beginning accounts payable for June?
150. He said, June,
Uh-huh,
you have to take. He said 115. No,
115,
no, 150.
150.
Uh-huh. Yeah.
Yeah, it says accounts payable, um, May 31st.
He's
May
one.
31st will be the amount that will
Yeah.
be beginning in
In
June.
June.
So we're gonna subtract out 150,000. What about July?
200.
200,000, and August
235.
235,000. Calculate those.
I'm so sleepy. I'm so
This
tired.
is co-air. What's the amount for June?
I thought that
1,540,000.
1,540,000.
July?
166.
166.
One,
1,460,000.
1,460,000.
August.
1,455,000.
The second one asked us to get cost of goods sold.
We have to calculate cost of goods sold by itself, right?
Hmm?
Do we have to calculate cost of goods sold by itself
By
before we get the
amount of what?
for the cost of goods?
I'm confused.
Oh no, I'm confused. So, okay, this is the second part. I'm so sorry.
Oh, you're okay. So to get cost of goods sold, what do you do? Beginning inventory plus purchases minus what?
Ending.
Minus ending inventory.
This was good.
So what was the beginning inventory for June?
200. No, 150.
Ending inventory.
Ending.
Ending inventory.
Mhm.
It was 200.
Mm-mm.
For merchandise,
I'm sorry, beginning inventory.
But
Beginning
June, it was
inventory.
for June. The beginning of the
Beginning.
it should be 150 for
Mm-mm.
May.
Where it says merchandise inventory.
Oh, it's 250. I confused with account.
So 250,000. What about July?
July, it should be 400.
400,000. August
300.
340.
purchases, which you figured out up here.
Yeah, 1,500.
1,540,000. 1,460,000. 1,455,000. What's your ending inventory?
Should be 400.
400,000 for June.
Yeah, 300 for July and 330 for August.
And then how much for August?
330.
So calculate cost of goods sold
It should be 1,690,000.
for June. 250,000 plus 1,540,000 minus 400,000.
Is it 1,390,000?
390. I got 360. 690.
July.
One million 560.
560.
August.
So 1,425,000.
1,425. Yeah, done.
See exercise 22-8.
You said you already agreed to do a lot because you have to start.
Yeah, we're doing 4 more budgets. That'll be quick. Exercise 22-8. I'm trying to get you out of here by about 7:15.
Okay, Miss Big. Oh no.
6:30.
6:23.
You can make. You need a break
It's the
to
cold.
get warm. It's warm in the hallway. It's just not warm in here. I need them.
You need one. You can.
It doesn't work.
So they need to fix it.
No.
They
They control your chocolate.
right.
Okay.
They made sure we couldn't mess with those.
Okay.
So they control it.
Yeah. Because if we, some people put it up, some people put it back, and like give chocolate to the thermostat.
It's real good.
Exercise, we're gonna do exercise 22-8, 22-11.
Oh, Mr. the President, come to see the way we are.
But it's 22 on 22 is not on exam 3 though. I mean exam 4 though. It's just 23.
Right. Right. And
But
even
your project is 22.
I know that's why I wanted to go over it.
Exam.
What you should say, did you open your project?
I did open it. I looked at
Because
it and then I
your
said,
project-
maybe if I can do my
No,
homework,
the
I can figure
project,
out.
the project is the same as 22. I'm almost done. I'm almost done.
Exercise
I got one question and a half, that's all.
exam 5 is supposed to be over,
24 and
but
25.
it's really gonna only be over 25,
Why not?
maybe, because I've always had it that way.
No.
I've always had it that way. And I think because at one point I used to give a project that was based on 24, and so I took 24 off the test, but it's
No,
either
you-
24 or 25, one of them.
You took 22 out of the test, out of the exam.
Yeah, now,
We don't have it. I don't see any 22. We got.
yeah, because your project is based on
22.
22. But that last exam is just preset, and I think it's only over one chapter. I can't remember. We'll figure it out when we get
But
closer
you know,
to it.
I like the project because it's like you learn everything. The project is on everything. So if you
I'm
got
probably
a
gonna
job,
try to do it.
yeah, if you got a job now, as a manager, managerial accounting, you can do it because it's on every single thing. I like it. When I see it, I say, oh, okay.
Okay, it says 22-8. Electro company manufactures an innovative automobile transmission for electric cars. Management predicts that ending inventory for the first quarter will be 75,000 units. The following unit sales of the transmissions are expected during the rest of the year. Second quarter, 450,000 units. Third quarter, 525,000 units. and fourth quarter, 475,000 units. Company policy calls for the ending inventory of a quarter to equal 20% of the next quarter's budgeted sales. Prepare a production budget for both the second and third quarters that show the number of transmissions to manufacture. So,
Budget shot.
doing this production budget, what quarters are we doing this for?
Second and third.
Second and third quarter. And we need to start off with the ending inventory. So budgeted ending inventory for the second quarter is going to be what? What are we going to calculate?
Oh, 100. No,
It's second quarter only.
it's 150 units.
Right, so 200 and, no.
450,000 multiplied by
It says here,
20%.
no, because you're trying to find out budgeted ending inventory. So if you're doing budgeted ending inventory, that means for the second quarter, whatever was
For the first quarter.
The third quarter
the
beginning.
third quarter beginning. So what was the third quarter beginning?
525.
525,000, and we need to multiply that by what?
20%. It's not bad.
So 20% times 525,000, which is how much?
A lot. 525,000 multiplied by 20. 105.
105,000.
Yes.
Third quarter, that ending inventory is going to be how many? How much?
475.
20% times 475,000 gives us what?
Miss again. 95,000.
95,000 for the third quarter. And so, what were the budgeted sales? You got to add those. You just used them. Budgeted sales were
450.
450 for the second quarter.
Yes, and 525 for the third one.
525,000 for the third quarter. Add those to get required units available for production.
The third quarter is 620,000, and the fourth quarter is the second quarter is 555.
All right, so now we need to subtract out what? You started with ending inventory, so you need to subtract out
75.
beginning
75.
Inventory, right?
Yes. 75,000.
So you're saying second quarter is 75,000?
No. This management will take that ending inventory for the first quarter, we pay 75,000.
And then think about it, we're doing the second quarter.
Oh, it should be.
So if it's ending inventory for the first quarter, that means it's going to be beginning inventory for the second quarter. So that's correct. It's
Okay.
75,000. What about for the third quarter?
It'd be the 450.
No, it's the amount we find for this.
Remember, ending inventory for the second quarter was what?
105.
105. So that's got to be beginning inventory.
Maybe for this one.
The third quarter.
Yeah. 555 minus 75 equals $480,000.
480,000.
Yes, for the second.
Okay.
It makes 620,000.
550.
550.
Good.
If I doesn't like Miss Williams, I will never be there today because it's too cold. I stay home and think about it.
I think that's so fun.
Eh? You do the same thing too?
But I'm nervous and fly.
Can me 4:30?
5.
Me,
Well, 4:30. Yeah, 4:30. I woke up.
yes, 4:30 because I have to leave my house at 5:30. I have to go to work. I start at 6.
Yeah, that's what
I stay all day.
I'm
Look,
having
look,
a
look,
good
look,
job
my feet. You
today.
see my feet?
Swollen.
Yes, swollen so bad.
Let's do quick study. I'm sorry, exercise 22-10. Refer to information from exercise 22-8. Each transmission requires 4 direct labor hours at a cost of $12 per hour. Prepare a direct labor budget for the second quarter.
For the second quarter only?
Mm-hmm. So direct labor budget, you gotta start with, do you have an example of that in your book? Direct labor budget?
It's 18.
Sale. You can see it. I can see it.
Oh, it's
You got it? What page? What page?
page 9.
921. Oh, I was so far.
Okay, so I started off with units to be produced. How much were they from 22-8 for the second quarter? Units to be produced.
Oh, 480.
So 480,000.
Multiply by 12.
Nope. Labor, what were the labor requirements per unit?
4. No.
Uh-huh. 4 hours? And they said it was 4 hours, right?
Yes,
Yeah,
4 hours.
So multiply that so we can find out the total labor hours needed.
1,920,000.
1,920,000.
Yeah.
And then what's the labor rate?
$12.
Uh-huh.
Multiply by 12.
$12. And so that means labor dollars is how much?
2 million.
No.
23 million. 0 4.
23,040,000.
Yes. That's a lot.
It is.
If I can win this money, I will stay for it.
Wouldn't we all? We would. We really would.
That's a type of job I would like to get.
Maybe 23 million.
No. Like I like numbers, to do numbers.
Mm-hmm.
That's I really do.
Okay.
Now they got all those programs. You think they need people for those type of job?
Most definitely. Nobody wants to do it but you. Seriously, nobody wants to do that.
I will do it.
There you go, and you're going to get paid top dollar.
So if you hear somebody who needs somebody to make calculation, call me please.
Sure will.
I like that. I like that.
So exercise 22-11, and then we're done. And this is a cash disbursements budget.
And they miss a lot those people who doesn't come. cash disbursement.
Mhm.
Let me see if I see it.
Says Hector Company reports the following: payments for purchases are made in the month after purchase. Selling expenses are 10% of sales. Administrative expenses are 8% of sales, and both are paid in the month of the sale. Rent expense 7,400 is paid monthly. Depreciation expense is 2,300 per month. Prepare a schedule of budgeted cash disbursements for August and September.
124, 122.
So the payments for that merchandise.
We can put purchase too? No.
What amount? Yeah, because it's gonna be the purchases for whatever the prior month was.
Okay.
So for August, what's gonna be that purchases amount? If it's based on the prior month.
Oh, 14.
Uh-huh. All right. And what about September?
19,200.
19,200. And then selling expenses, they said was what percent?
10% of sale.
10%
And administrative is 8%.
of sales.
Yeah.
So if we did 14,400 times 10%, am I doing that right? No.
Yeah. 10%. And then after that, the other one, 8%.
Wait a minute.
No, it's for sale or for
Of
purchase.
sales. I didn't see this.
It's
Okay,
50,000
times, no.
for the sale.
Sales, remember, if you're talking about sales for August, if you're talking about selling expense for August, you got to use August sales. What were the August sales?
50. Tony, that's what.
What does it state right there in the chart?
August sale is 72,000.
Right. So 72,000 times 10% is what?
7,200.
7,200. That's the selling expense. What about for September?
66,000.
Times 10%,
6,600
6,600. Now, administrative expenses,
is 8%.
8%
Times 70
of sales, correct?
Yeah.
Okay, so 72,000 times 8% gives us how much?
5,760.
5,760. 66,000 times the 8%,
5,280.
5,280. All right. And then you got those other expenses, right? What else did you have?
You got a depreciation expense.
Think about depreciation.
Your rent expense.
Go back to the depreciation part. Depreciation doesn't involve cash, does it?
Yeah. I
So-
read it.
Okay, so we don't put it
Yeah,
here.
we don't
So
put
it's
it.
not included. That was just to throw us off.
Right. It's important to know that because this is the cash disbursement.
I read it.
So rent expense
Yeah.
was how much?
7,400 is paid monthly.
Okay, 7,400 for both months. So that means total cash disbursements.
You are
Gotta
going to
add all that up.
Yeah.
Alright.
No. 70.
You gonna do August and not do September?
Yes. 5, 7, 6. We are team. 34,760.
34,760.
Are you done for your day?
38,401.
Okay. Good. All right.
Okay, see you. Nice to meet you.